Welcome to Cash Chats with me, Andy Webb from BeCleverWithYourCash.com. This is the podcast to help you make the most of your money. In episode 377, myself and Deputy Editor Amelia Murray are going to take you through the big money stories from the last 7 days, so you know what's been going on, and we'll share with you what you need to do about it as well. Just waste no time and get straight into it. And Amelia, welcome back. Hello, how are you?
Yeah, I'm good, thanks. How are you doing?
Yeah, very good. I'm in a hotel room recording this right now. So I do apologize to anyone if suddenly there's noise outside of people checking in or cleaning room staff going through making noise. But hopefully it's going to be all good and we can just get along with it. Right, Amelia, the first story this week is inflation. What's been going on with inflation?
So inflation has dropped, which is great news for everyone, considering this high inflation environment we've been living in for the last couple of years. You only have to walk into the supermarket to kind of, have to stop yourself from fainting because of the prices. But essentially, it's dropped to 3.2%, which is not as much as expected, but it is the lowest level since September 2021. So there's kind of, a bit of relief there for everyone. Inflation is the increase in prices over time, and it basically indicates a decrease in spending power. So it's the reason why you remember getting more for your money, years ago. However, it's not a decrease in prices. It just means prices they're still going up, but they are going up slower. So yeah. So
because a year ago it was double digits, wasn't it? So yeah, we're looking like 10, 11%. So this is a good movement for inflation to be down to 3.2, and we're not far, I guess, from the target. The Bank of England want it to go to 2%. That's where they'd like it to be. But yeah, we're getting close to that though, aren't we? So you say it's good news it's coming down, but prices still going up.
Exactly. And I just need to bring up olive oil, if I may. Because a few days ago, I saw someone on Twitter being like, what is going on with olive oil? And they had bottles of olive oil in Tesco for £16 a bottle. And I was just like, blimey, I cannot believe it. And then this morning, I had to go get some olive oil, and I went to Aldi before work. I don't buy olive oil that much. I don't think people do. But the last time I bought it, it was under £6, and I still thought that was extortionate. Went in today, and it is £6.49. So it's a significant increase, and I don't know what's going on, but it makes me want to cry.
Yeah, I think this is what's so annoying about all this. Yeah, lots of headlines. Inflation's coming down. It's great, but we're still day to day spending more, and that's not going to change. Some things potentially can get cheaper, and one of the big things that often when they measure inflation that might sort of go down is like energy bills. And I think we're kind of expecting the next inflation figures to be lower still, simply because energy bills would have dropped a lot over 12 months. But we're still, every day increases, things are going up, and they're not necessarily going down in price. What else is, you said that inflation has come down, but not as much as expected. What are the things that are kind of making it a little bit sticky, making it sort of stay a bit higher than expected?
So food inflation is one of the ones that has slowed, but motor fuel prices have picked up. Furniture and household goods, interestingly, is down for the first time since December 2020, and transport has been consistently falling for the last 5 months. And I read something about crumpets being a bit cheaper as well.
Yeah, it's interesting, is that this stuff, that the big reason why we talk about inflation, well, two things. One, you said, it's the real cost of living. So if you are not earning enough, or your savings rate is lower than inflation, you're losing out. But if you now, with inflation where it is and savings rates where they are, you can make sure your savings rate beats inflation. So that's really good. But the big reason where we get interested in this, and I guess maybe other people indirectly, is inflation is what is driving the Bank of England to choose what it wants to do with the base rate. And I know that obviously every 6 weeks when the Bank of England meet, I give you these updates about exactly what has been decided. It looks like, because it hasn't moved down as much as was expected, and we're not talking about by much, it's only a small amount it didn't change by, but the kind of predictions are that the Bank of England might even delay any cuts even further.
Yeah, exactly. So because it hasn't come down as expected, the Bank of England is holding, the base rate for now. And so that's that really influential interest rate, which has the impact on mortgages and savings. We wait for the outcome of every meeting to see what's going to happen. And yeah, unfortunately, it hasn't recovered since that disastrous mini budget. And yeah, for mortgage people, we're still kind of feeling it. And I say that because not that long ago, last week I got my annual mortgage statement, and again, I wanted to cry. We had olive oil this morning, mortgage statement, and yeah, I am awaiting the Bank of England's decisions more closely than usual.
Yeah, and the next meeting is on May the 9th. So obviously, we'll do a full update for you on the podcast on YouTube and over on BeCleverYourCash.com to say what happens and what that might mean for you. But the latest predictions, and as I always say when we do those updates, these predictions change all the time. The latest predictions said that maybe we might not even see the first cut until November now. At one point, they were saying it could happen in May or July, but now potentially November. So again, let's wait and see. Don't worry too much about it right now. Let's wait and see what happens. But yeah, it'd be interesting one. We'll keep you updated as things go along. Now, talking of price increases, there's been news from BT and EE, if you have any mobile or broadband with them, about how much your bills are going to go up next year. What's going on now?
Yeah, so if you are a telecoms customer, which many of us will be, you'll probably notice, midway through your contract, you often get like this random price rise. You kind of know it's coming, but you're never sure what it is. It's often linked to an inflation rate of the future, which is unknown. It's a bit shady. It's very confusing. And then you're kind of hit with it. And it's an area that the regulator Ofcom has been looking at for some time. And what they've decided is, it's unfair. And so it's semi-banning these sort of strange and mysterious price hikes in favor of an annual price rise. So telecoms providers will still be allowed to raise their prices every year. However, they have to be transparent about it. So when you sign up for a contract, you have to know exactly in pounds and pence how much more your bills are going to rise the following year. So BT and EE are the first to do this. And so if you're a customer of them, from March 2025, you will know that your prices are going up between £1.50 and £3 a month, depending on the service. And PlusNet is expected to introduce this new kind of transparency in the summer. So it'll be interesting to see, what providers kind of, introduce that kind of structure next.
Yeah, because this is interesting because we know it's coming, although it's not actually the rules, it's a proposal. BT and E are saying, we'll do this, we'll be first off the bat to do this. So we're very likely to see everyone else follow suit, either because of their own choice or because when they're told to do it. Where I found this interesting and maybe a little bit worrying, particularly if you're a money saver who does shop around for your bills, these are fixed for everyone. I assumed when they're talking about these rules, you'll know what it is in pounds and pence. It still might be linked to what you're paying. But this isn't the case. So if you have a mobile phone with EE mobile, that £1.50 is added to your bill regardless of what you pay right now. So if you pay £10 a month and you've managed to haggle down a deal or you've gone via a third party to get a really good SIM deal, adding £1.50 to your bill is an extra 11.5%. That is huge. That is going to be way more. But just talking about inflation, hopefully being around that 2% mark over the next few years, give or take a little bit. So you'd be paying well over the odds of what you would have been doing under this current rate. Of course, the flip side of that is if you have a really hefty bill for whatever kind, then your percentage increase will be less. But that to me is a little bit worrying and something to keep an eye on. And this will be in contracts. So again, we only know about BT and E right now. They're saying that if you start a new contract or you renew your contract, this will be in there for the price increase next March. Obviously, if you've only just renewed a contract or started a contract, you'll have the old terms, so you will still go up by a percentage, most likely. And then the next time you renew, you'll get these new terms. But interesting to see where things are going. But I think potentially going to be quite bad for those people who are quite expensive increases. Of course, the flip side is maybe to avoid contracts if you can. No, you can't with broadband, but with mobile phones, maybe you're paying that little bit more to go for a 30-day SIM or a 12-month SIM rather than 24 months and 36 months where you're locked into potentially hefty increases month after month. And I don't know about you, I always try and tell people just switch, just move around, look around. Maybe you can get a good deal with your existing provider and haggle it down a little bit. But so I think this is an interesting one, but bad, surprisingly bad news hidden within it.
Yeah, definitely. It's kind of, the transparency is great. And I think, in my kind of experience of kind of getting feedback from people who have these contracts, it's a really controversial rise, the mid-contract hike, which, you kind of have an idea that's coming, but you don't know how much it's going to increase by because you don't know what the rate of inflation is. So in a way, it's kind of, the transparency is welcome, but actually, companies often find a way to diddle us anyway. So it's that classic giving with one hand and taking with the other, I think, which I'm kind of saying every episode now, but I'll make it my catchphrase.
I know, this is the thing, isn't it? I mean, so many of these stories we do talk about, they're important to know about. But but it's rare we do get those good news stories, but they are out there, of course. Don't worry, there are good ways to save money and beat the systems, and we'll be sharing that often in our other content because they're those little hacks and tricks that we can help you save some money. But these ones, there's still some ways you can save some money, even if these things are happening. And just talking about businesses maybe trying to get make profit from us, which I guess that's what they're there for, but it doesn't seem very fair. There is an interesting change to Barclaycard's credit card terms and conditions that's come through. And I saw a few people sort of told me about this, but I spotted a really nice grid post from a friend of the podcast, Sarah at Debt Camel, who's actually broken down what the increases could be. But do you want to share us, first of all, exactly what they're doing?
So this is going to affect some customers. We don't know how many yet, but Barclaycard has told some customers that they will be reducing their minimum monthly payments from the 22nd of July. So it's upcoming, which on the surface kind of sounds welcome. It sounds, it sounds like a good thing, but actually, you should be trying to avoid just paying off the minimum of your credit card every month, because the less you pay off the balance, the longer it takes you to clear it. And so the more you're paying interest in the long term. So it's an interesting move that kind of seems to be dressed up as this, Barclaycard has said it's, it's to introduce flexibility to customers. It's kind of, really selling it well, but essentially it's going to be increasing its profits from, the interest repayments of customers. So it's definitely not what it seems.
Yeah, so there's no point in us giving our own example because Sarah did her own sort of calculations, which are a great example here. So let's say you had £5,000 at 24% on a credit card with Barclaycard. Under the old minimums, which were between 2.5% or 3.75% of that minimum every month you have to repay, it would take 14 years to get rid of that £5,000 debt. And the interest you would pay was $3,500. So that in itself is huge amount of time, huge amount of money, which is why we say don't just pay the minimums. But this new rules, this 1% level, would mean it would take 31 years, so more than twice as long, and it would cost you $8,500 in interest. I mean, it's really, really shocking stuff. And this is about, they're not really doing this to help anyone apart from themselves, to help their bottom line for the people who just pay the minimum every single month. That's all they do. I think it's, shocking they're able to kind of just get away with this and sell it as something we're giving you flexibility is really cheeky. The answer is pay more than the minimum, right?
Yeah, I think what's worrying here as well is we don't know what customers had been offered this and why. I mean, we could assume that it is people who are already paying the minimum, and and people are paying the minimum because they may not have the financial resilience, or that's all they can afford. So essentially, they could be, they're the people who shouldn't be paying all that interest either in the long term. So I don't know, it kind of doesn't sit right with me because I don't know who they're offering this to, but it feels like if you're only able to afford the minimum on your credit card, then there should be kind of better support and more of it for you, rather than this promise of flexibility, which isn't going to help you in the long run.
No, I mean, obviously the rules, although the rates are different, these rules are true for any credit card. So though generally what I'll say to you guys is to try and make sure you clear the balance completely every single month, particularly when it comes to if you're using a credit card for things like cash back and other kind of perks. So you don't get charged interest at all. That's the best thing to do. But obviously we know so many people are using credit cards because they have to. That's the only way right now they can afford sometimes even those essentials. Do try though and just pay as much as you possibly can. Don't just let the minimum go there, because as those example shows, it will be a huge amount of money over a huge amount of time. So please just try and do as much as you can. And obviously we're not going to go over it again now, but we have covered previously about debts. If you have bigger debt problems, then just seek that support from places like National Debt Line and Step Change to try and help you, work out the best ways of clearing all those different debts and different things. So from this to maybe people unwittingly getting caught out and spending money, to a story around stamps, which we've seen. This is money covering a few times. I'm sure other people have been doing it here. What's going on with stamps? We've just had some price increases. Surely there can't be more we have to worry about.
Well, the big news is that there's been an influx of fake stamps, as much as 1 million a week, which is loads.
Yeah.
1 million fake stamps a week entering circulation coming from China. So that's kind of big news in itself. But what's happened is, in an attempt to, clamp down on it, Royal Mail is fining people who receive the mail or collect the mail with the fake stamp. They're fining them £5. I mean, I think it's annoying enough if someone doesn't pay for the postage and you receive it and then you've got to, you know, pay the extra. And also weirdly around Christmas,
Yeah.
my friend sent a Christmas card to my friend and she didn't get it for months, and then she had to pay like £2.57. And I was like, oh mate, it wasn't worth it. Can I give you the money, but you should have left it. But with this, like, you know, the people who receive the mail have got no control over what the sender is using. I mean, I don't think people are doing it on purpose. How are you supposed to tell it's a fake stamp? And then to be fined on the doorstep, or however it's coming, because you've received it, I think is really unfair.
Yeah, it's difficult with these things. You talked about the Christmas stamps. My friend was telling me the same thing they had, that someone had sent out to all of them. They'd used old stamps without the barcode, and it was, everyone got charged whatever it was. They didn't know what it was. Effectively, you go to the sorting office and you have to give the money, and then they give you the letter or whatever it is that's been undercharged. And it could be spam. It could be nothing important, but you've paid. There's no way back around it. And this thing with these fake stamps is another iteration of that. But you know, it's £5. It's such a lot of money to be doing it. And this comes back to something that I normally talk about it at Christmas, because I think that's about the one time that people actually do tend to send stuff, or at least that's probably one of the few times I generally send more things. Not that I do that often now. This is around where you buy your stamps, because obviously to have a fake stamp, you've got to buy it from somewhere, and you're not getting that from the post office or from WH Smith's or from Tesco or any of these kind of places. They come more official sellers of stamps. You're probably getting them because you bought a job lot of them online. You know, you've seen, oh, look, stamp sale. Well, that seems like a good price. I'll buy them online. Or you've gone to the corner shop because you're in a bit of a rush. And the problem with these places, they don't have to buy them from Royal Mail like the official resellers do. They can just buy them from anywhere. And sometimes it will be legitimate stamps and they're buying them from like a cash and carry or something like that. But sometimes who knows where they've got them from? They'll buy them. They're not going to necessarily check them. And if they're fake, you're buying it off them and then you're using it. And it's a really kind of risky reason to say, like, just, if you're going to buy a stamp now, don't buy them from a corner shop. Don't buy them online. Just buy them from somewhere that's safe. One, you'll avoid this chance of them being counterfeit. Two, you'll avoid paying over the odds, which is the other problem you get if you buy them from other places, because they can charge what they like with stamps. So yeah, a worrying thing. I mean, so fewer and fewer of us now are sending mail, but when we do, it'd be a nightmare to send something and someone has to pay £5 to get the thing that you've sent through. So the next story, Amelia, is around retirement. I know a lot of people watching or listening might be thinking, oh, that's ages away. I don't need to worry about it. But in fact, this story is saying you should worry about it now, because if you leave it too late, you might not have enough cash for the lifestyle you want, right? So what is this big piece of research?
So every year, the Pension and Lifetime Saving Association comes out with the same report, and it's looking at what you need to retire at the level that you want. So they look at kind of, your basic, your moderate, and your comfortable retirement. It's actually really interesting. It's always really nicely illustrated as well. So it takes into account how much you will spend on home repairs or holidays. Are you a 5-star hotel kind of person, or are you happy with like a week staycation in the UK? Also, how much you spend on food, birthday and Christmas presents. So all those kind of things. And it comes up with these figures of what you will need to retire to get that. What it's seeing in this one is, there's a huge shortfall. So people aiming for a retirement pot of £250,000 are actually ending up with £131,000, which is huge in terms of what you will then get as your retirement income. So they've used the example of, this 250,000 pot can buy an annuity. So that's providing you the guaranteed income for life. And it's worth £12,091 a year at today's rates. But if you had £131,000, that's going to be slashed to £6,332 a year, which isn't going to go far in terms of having like a fixed income. Stuff that's also come out in the report is, this level of income that you need for this kind of comfort in old age. And it's suggesting that if you're a couple, you need £59,000 a year to have the top tier level of comfort. So that will be £225 a week on food, a 2-week 4-star holiday, and 3 weekend UK breaks, those kind of things. I've seen research in the past which has really nice illustrations of, if you're the kind of person who gets a haircut every 6 weeks compared to someone who, cuts your hair at home. So it's always kind of, good to see these tangible examples. But if you're a single person, it's saying that to have that level of retirement income, you need £43,000 and £100 to cover, your meals out, your holidays, theatre trips, and all that kind of thing. So there's this big gap, and the longer you leave it, kind of the more trouble that could appear.
I think what's interesting this year as well is how much those figures have increased from other years, and it just shows you forget about we talked about inflation. It doesn't just impact now; it will impact how much we have to have in our retirement pot, significantly more for us to get there, because whether it's 5, 10, 20, 30, 40 years away, inflation will keep increasing that pot. So these figures, obviously, we're talking about at today's price is what you need, but they're still higher than a year ago for those levels. So not only do you have to be thinking about how much you're putting into your different retirement options now, because you can't rely just on the state pension that will not cover you enough, even if it's there. You have to be thinking about putting more in potentially now to reflect the fact that inflation would have increased what you're going to need at the end. So it's a interesting one to kind of think, to really kind of think about what you need in retirement, and then trying to think back about how much you're putting in now and going to be putting in over the coming years to get to that target pot size.
Yeah, absolutely. Because it's painting a picture of today. But I think by the time I retire, it's going to be a completely different story. So it's definitely worth thinking about now.
Yeah, and obviously don't forget as well, employer contributions will count towards that money you need to put away every year, plus tax relief as well. So it's not like you're having to put in all the money every month to try and get to that amount. You don't personally have to save a pot that was kind of like 250k over time. Your actual contribution will be less than that, but obviously the more you put in, the more you're going to get from those other sources. So please do think about that. Now, one more story to talk about this week, and this was around train delays. What's going on with train delays?
Well, it's I don't know if you've been part of the chaos of the last few years, but I was talking to a Bulgarian friend a few months ago, and she was like, has England always been like this for trains? And I was like, I can't remember a worse time than the last few years. And that's not just the strikes. Like people strike for good reasons, and I'm not anti it at all. But it's kind of as part of the the whole situation, the whole story, where we've had signal failures, there's technical issues, there's staff shortages. So the whole thing is kind of combusted. And what we've seen is in the past year, there's been 320,000 train services cancelled or part cancelled. And as a result, the payouts for the compensation for the disrupted journeys has reached record levels of 101.3 million in the year to April 2023. And that's an increase of 155% compared to the year before. So it's huge. Like, this is massive. I mean, I see it as a good thing. I think it's great that people, we have the delay repay system. That means you're entitled to compensation if you're delayed by 50 minutes or more. So I think it's great. Like, it's very easy to forget to claim, especially when you are repeatedly delayed or your journey's repeatedly cancelled. Which actually reminds me, I do have train tickets in my pocket to claim. But so I think it's great that people have realised their rights here. And just so it doesn't. It kind of depends on how much you're delayed by. So the compensation starts at 25% of the price of a single ticket, but the later you arrive, the more compensation you're entitled to. So essentially, like, the max, you can get your entire return ticket refunded if you're delayed by more than 120 minutes. And you usually have to claim the compensation via the website of the train provider. And they often have forms that you can kind of fill in and submit your tickets.
It's really interesting how much it's jumped up. I think the reason you think it's got worse in the last couple of years is because you moved to Brighton. And the train provider you've got there is just like notoriously just awful for delays and cancellations. So I think you personally have suddenly gone, wow, this is really different before, because it's so bad. But I think it's always been like this. And it's a shame how much we pay for train tickets, how expensive they are, and for how poor the service can be. It's good that we've got this in place, this potential for you to get this money back, and how much easier it is now than it used to be. Going back probably even just 10 years ago, you had to have it as a voucher, which you could then came in the post, and then you had to kind of use that to buy your train tickets at the ticket office. At least now you can get it paid directly into your bank account. You can have it as cash, all these sort of things. The online forms, like you say, make it so much easier. These delay replay rules, if your train operator has signed up to them, most have, not all of them have, means that you'll get something back 15 or 30-minute delays. That makes such a difference. Even season ticket holders can, get some of their money back if they are again delayed. So it's well worth, putting the effort in to do this. I also like what you said there. You've got tickets in your pocket, because this is something which is so I always used to say to people when I wrote about this, I haven't done it for a long time. I need to update the content about this. I think I stopped when the pandemic happened and didn't get on trains for a couple of years. Trains went out of my mind a little bit. But if your train has been delayed, when you get to the ticket barrier, do not put your ticket in the machine, because it will eat it and you won't be able to then have it, because you need that as proof of your journey. Now, of course, most of the time now when I'm buying tickets, I'm buying them online with apps and they're digital tickets. But if you have a physical ticket and you've been delayed, keep hold of it so you can submit that claim.
Yeah, and take a picture of it when you've got them as well. I found this, I mean, in my clubbing days, which are rare now, but you put your coat in the cloakroom and you take a picture of your ticket in case you lose it, and then they can't give you your coat back until, right at the end of the night. But yeah, it's worth taking a picture of your tickets on your phone while you're out, or while you're stuck on a delayed train, just so you've got it. Yeah, because I'm terrible with pockets and stuff in them. So yeah, take a pic.
Yeah, and there's also a really useful website called recenttraintimes.co.uk that you can go into, and it will tell you what the official time was that the train actually arrived for your refund. Because again, whether it's 15, 30, 60, 120, whatever it is that you're claiming for, whatever that train operator allows for, it's that horrible. I get to this point where I'm willing a delay to be longer by a minute or two, just so I can get that compensation. And invariably not, they sort of come in just under where I can get compensation. But yeah, if you're not sure exactly when you arrive, you go to do this, recenttraintimes.co.uk is a really good tool to kind of, for a fact that your train arrived at this time, which was this amount of time after it was meant to arrive, and you can put that information into your claim. So Amelia, thank you so much again for taking us all through these stories. We'll do another one of these next Thursday as well as ever. So alongside our normal Tuesday episode. So yeah, thank you so much for joining us. Remember, head to becleverwithyourcash.com for more information about everything we've spoken about in the show notes. We'll also put a link to the news stories which we use for this. If you want to read more about individual ones or any links on becleverwithyourcash.com that might be useful, you'll find them there as well. So yeah, thanks again, Amelia.
Nice one. Thanks for having me.
And we'll see you again soon. Bye.